Good evening, ladies and gentlemen. This is Barry on behalf of X90 and investing.com, and welcome to our webinar on understanding charts. Now, tonight's class is sponsored by X90, one of the world's leading platform providers. And they offer trading in stocks from over 20 countries, plus Forex, CFDs for Forex for currency, for commodities, and for indices from around the globe. They're one of the leading providers, and if you're not trading with anywhere yet, or you're looking for a great platform or a very easy platform to trade on, try X90. They have a free demo account. You have real live market data and trading trends. You have no commissions, and you can trade from around the globe. They also offer several bonus programs that you can find out about once you've registered for a demo account. And you can go easily to www.x90.com and just click on demo, and in a matter of seconds you'll have a live demo account open, and you can actually follow us along with us tonight and use their charts to start developing your trading strategies. So let me real quickly pop up their platform. Let me just log me out because I haven't been active. The security measures to make sure you're protected at all times. So as you notice, their charts are right there on their trading floor. Their trading floor is very straightforward, not complicated at all, but you can use their charts. You can have all their indicators. You can do everything. But if you just go on here and just click on a demo account, you'll open an account just looks like this, and they'll fund it for you, and you can start playing around. You can go down here to the bottom right and click on Start a Tour, and you can just follow that tour, and it'll take you all around the platform. And especially for those of you that have not traded in CFDs before, and follow it all along. And if you want to learn how to open a position, just go up here to Start Tour, and it'll show you step by step how to actually make a trade. And then you can start using your charts to build your roadmap to success and take everything you're learning in tonight's class and try to apply it on X90 or whoever else you're trading with, or wherever else you get your charts. Now tonight for class, we'll be using charts from tradingview.com as well as investing.com. And charts are one of the best ways to, or one of the most important, crucial trading tools you have. So let's go back to my PowerPoint and let's start talking about what these charts can do and how to understand them. So let me pop it back up on your screen here. And learning to read a Forex chart is considered to be somewhat of a science, but don't let that scare you away. They look complicated at first glance. Forex charts or CFD charts or index charts, all asset charts are drastically different depending on what options you want to use, but you decide how complicated you want them or how straightforward you want them. Now, charts usually have settings for the display style, for the price, the time frame you want to view, and time frames can be anywhere from 1 second to 10 years, depending on the charting system. And they can also be displayed as candlesticks, a line, or a bar chart. Now, using charts are like building your roadmap to success. Because if you think of charts like a roadmap or an atlas, like when I learned to drive, somebody just wrote in they can't hear it. Can you guys type in and let me know that you're hearing me? Just one or two of you just write in and let me know that the voice is coming out, because all my system shows the voice is fine. Thanks very much. I appreciate it. So when I started to drive 40-some years ago, 50-some years ago, whoa, that's scary, 50-some years ago, 50 years ago, we didn't have GPS, and we had road maps and atlases. And when you would open up a road map, you'd have all of these crazy lines all over the place. But once you learned how to read them and you got practice with them, you'd find that you could get yourself wherever you needed to go successfully. But you have to learn the basics of what these lines mean on a chart or an atlas. So it's the same thing with charts. Once your eyes are accustomed to looking at them, you'll have no problem at all interpreting, especially your own charts and most basic charts. There are some people out there that, because most charts are customizable, that have all these complicated, convoluted stuff on their charts. I can't follow along, but this is their map. So they know what all these color codes they have on there, all this stuff they have over there. But there's some real basics you need because you have to learn and build from your foundations. Now, to start out, charts typically have several different display modes for displaying price. One method that can be displayed is called Japanese candlesticks. Now, all of you guys that are probably here that are new traders or novices or that have recently started trading, you're probably all using candlesticks. The problem with that is unless you're going to spend time, and I'm not talking about 15 minutes, I'm talking about days and weeks of learning how to read candlesticks. You're just wasting your time because candlesticks are part of a trading system that have 32 different basic patterns that also have positions, and unless you learn to read those, you're going to use the biggest fallacy in the markets because too many people think red candles tell you things are going down and trade it to go down, and lots of green candles tell you things are going up and you should trade it to go up. Unfortunately, it's got absolutely nothing to do with candlesticks. The basic chart, the bare basic chart, we start out with, there's three types of charts, okay? And we start out with line charts, bar charts, and candlesticks. And these are the three main categories. All the other charts, and today there's all kinds of unique kind of things people have developed, but they're all variations of these three kind of charts. And once you have your chart, the more detail you add onto that chart, the less likely you're going to get lost going where you want to go. So the bare basic chart is called a line chart, and this is what you're looking at on the screen. Now we're going to look at three different types of charts. They're all for the euro-US dollar only because it's the most traded asset in the world. And we're looking at a 30-minute chart. 30 minutes is the time frame, and we'll talk about time frame shortly. But on a line chart, which is what we're looking at, is the bare bones piece of information. Almost all line charts are based on the close. So if we're looking at a 30-minute chart, that means every 30 minutes, a dot is put on the chart for the price of that asset at the end of that 30-minute period. And then the next 30 minutes, another dot's put on that chart, and the next 30 minutes, and the next 30 minutes. And from there, we connect those lines together, and you have a line chart. Okay? It doesn't give you that much information. It gives you a quick visual representation of how an asset is trading. But it doesn't give you any detail. It doesn't let you draw any conclusions except here we can see the euro is going down. Excuse me. The next and my favorite chart is called the bar chart. The bar chart, and this is the same exact asset we were looking at in the line chart. The bar chart consists of a bar put on a chart every 30 minutes in a 30-minute chart. There's a 1-hour chart, it's every hour. This bar is a visual representation of how price moved in that entire 30-minute period. And what it shows you is the open, the high, the low, and the close for that time period. We also can see commonality between price points. We can see that in here, look at this, we see this open and close all at that one level. Or we see all these bottoms, the lows hitting all of that same level here. Now, you would never see this in a line chart, but every low in that time segment stopped at the same low point. That's telling you that price level is intricately important. Here, as price was moving down, look at all those common prices along the trend line that it touched. So we start to see some visual representation of price. And charts and technical analysis is all about visual imagery of price, understanding price through seeing how things are moving. Now, A bar chart is sometimes referred to as an OHLC. Open, high, low, and close. So remember, in the line chart, at the end of every 30 minutes, we put a dot on the chart. In a bar chart, at the end of each 30 minutes, we start a new line. And that new line, we put a dash across to the left, or a doohickey to the left at the open. That means the price it was at the beginning of that 30-minute period. At the end of that 30 minutes, we put a dash across to the right. We then put a dot at the highest that price was in that 30-minute period, and a dot at the lowest price the asset traded at in that 30-minute period. And then we draw a straight line connecting them all together. Therefore, we have the open, the high, the low, and the close. And we see this in this bar. So what do? We see a visual representation of how price moved in the 30 minutes, how far up it was able to push, even though it didn't close at the high. We see how high it went. And we can also make some interpretations, because when you step, if you imagine it's a step on a ladder, the open, and you step up to the close, that's a bullish signal. That's telling you the bulls were in control of the market. Okay, guys, I'm going to try to, I've got close to 1,000 people registered for this class. Okay. I can't deal, unfortunately, with individual problems. Okay. Now, for those people who lose their hearing, it's got absolutely nothing to do with me. It's most likely your internet and in your country. There's nothing I can do to assist you, because I have all of these controls on my screen that tell me about everything. So before, in the very beginning class, when somebody said they didn't have hearing, I tried to check with everybody else and everybody heard us fine. Now I'm getting somebody who writes in, I can't see the slide. You need to refresh your computer. Any problems exist from your internet to your computer. Okay? Otherwise, it's the entire class. So I can't help you. So writing it into my screen doesn't help. Okay. The other thing is, I would greatly appreciate if you wait till the conclusion of the presentation, because all these questions you're all writing in are very, very nice, but they're all going to be covered in tonight's class. And if I stop to answer every question in here, and you keep asking me the same question over, we'll get to it. Okay, it's been structured in a very presentable way. Towards the end, if you really don't understand or you really get lost on something, I'll be glad to explain. But, with 1,000 people, we need the time to get through the class. So, thank you very much, and just bear with us as we get through the class. Okay, I'll be back with you in a second. Okay. So we have a bullish signal when the price at the close is higher than the price at the open, which tells you that the bulls control the market in that time segment. Okay. And that is a bar chart. Now, when the close is lower than the open, or in other words, you step down the ladder, it's a bearish signal. Now, we're going to go from here, and we're going to look at the same asset now on a Japanese candlestick chart, and you're going to see something that's almost identical. Okay. Now, candlesticks, we're looking at a candlestick chart for, again, the euro is the same asset, same time frame, same everything, 30 minutes. Now, what you have is virtually the same thing as a bar chart, except we color in the area between the open and the close. Okay. And this forms the body of a candle. And then the high and the low, they get connected to the body, are referred to as wicks. Let's follow this how we do this. At the open, we put a dash all the way across. At the close, we put a dash all the way across. At the end of that 30-minute period, we put a dot at the highest point, and we put a dot at the lowest point, and then we connect them to the body. So virtually, this is all exactly like a bar chart. Correct? So you're seeing the same visual representation. The difference is on a candlestick chart, if it was bullish, if you stepped up from the open to the close, you would fill this in with the bullish color you're using. Okay. In the old days, it was a black and white system. Today, most of us use a green and red system. But in the old days, you'd leave it white, and that meant it was a bullish signal or bullish time frame. And today, in the black-red system, we'd either fill it in with black or fill it in with red, and that would tell us it was a bearish time frame. Then the wicks are the same as the open and the high. The difference is with candlesticks isn't the color of the body. It's the size of the body of the candle and the size of the wicks. And there's all kinds of funny names for these shapes, these sizes, like there's harami, there is marabuzu, there is doji, and you have to learn what all these mean. And then there's 32 different interpretations of the size of the candle with the wicks and the placement to the candle next to it. Very few of them have to do with whether they're greens or they're reds. Now, sometimes it's a combination of a green next to a red or a red then next to a green. But an abundance of red or an abundance of green doesn't tell you anything. So this is why candlesticks are a great, great trading system. And you have to learn the entire system. Okay. When you do, they work wonderfully, but it means you have to put more effort into this to understand it. Okay. And what's happened is today, because of all the Java and HTML computerized charts, everybody has access to these, and so they just want to trade from candlesticks. And the thing with candlesticks is, and I keep reading it because I've been teaching it for a lot of years, and the first comment I get from new traders, well, I'm trading with candlesticks and I love them, and when I see all that red, I traded, and it's the first mistake you can make. And it's not that I don't love candlesticks, because I trade from candlesticks. Okay, it's that you have to not get stuck with the red and green, because we're human beings, and the reds and the greens also have a psychological effect on us. So when you see these reds or these greens or the blacks and the whites or whatever two-color system you're using, you tend to feel something. You tend to say, oh, that's telling me to trade it to go down. Okay. And it's hard to get away from that. Even when you're an experienced trader, it does have an effect. So please, if you want to learn candlesticks, and we offer classes all the time on candlesticks. And we used to do, and actually I think next month we have a 3-week series on candlesticks. But that's how long it takes you just to learn the basics. But once you do, they're worth the effort. Okay. Now that we've talked, though, about the 3 different types of charts, let's talk about the next thing that confuses most people. And this is called time frames. Now, a time frame, okay, price does not change. Price is written in stone once it happens. If you're looking at a 1-hour chart, you're putting a candlestick, a bar, or a dot on your chart every 1 hour. If you're looking at a 30-minute chart, you're putting 2 of those on the chart. Now, what happens is you're getting more detail, because say if you're looking, let's say hypothetically you're looking at gold, and gold at the beginning of the hour was trading at 12.50. Gold at the end of the hour is trading at 12.75. So you see this candlestick or this bar that takes you up to 12.75 for the whole hour. Now, that's all you're seeing. Okay. Now you have the open, the high, the low, and the close. But if you broke it in half-to-half-hour segments, what happens if the first half hour, gold hadn't moved and gold stayed at 12.50 and started that half hour at 12.50 and ended that half hour at 12.50, and then the next segment opened at 1250 and went straight up to 1275. You knew that momentum was in that last half hour, and the bulls still had the strong momentum going forward. But say if you were looking at that bar chart and it's a 1 hour, it was all the way to 1275, then down to 1250, up to 1275, down to 12. And it was erratic, and there was a big fight going on between. You wouldn't see that in that 1 hour, but if you broke it down to a half hour, you might be able to see that. So you get more short-term detail. Doesn't change the prices. It changes the visual aspect. So if you were looking at a one-day chart, and gold opened the morning at 1250 and it closed the afternoon at 1250, and it might have had a high at 1275 and a low at 1225, you would see that on the bar chart or the candlestick chart, but you wouldn't know it hit that high early this morning, 23 hours ago, and it hasn't been near that high the rest of the day. And you wouldn't know that it hit that low just in the last hour. Well, that's crucially important to you that it hit that low in the last hour, because that's telling you the bears are more in control in that last part of that hour, that last part of the day. So it's an important thing to know. Plus, you using the time frames, you get to see little inklings and personalities about an asset. Say, sometimes gold is more volatile and has more reaction between the overlap of the Asian to the European session. And you could see that if you were looking at more detailed charts. So your time frames give you more visual imagery of how price is moving. But remember, a screen can only hold so much in front of you. Depending on the screen, the chart you're using, maybe it has 100 lines, maybe it has 150 lines. So if you're looking at a 1 hour chart, you're seeing 150 hours. If you're looking at a 15-minute chart, and you can have you only see 100 lines at 15 minutes is 1,500 minutes. So you're seeing, a day or two. Okay, so it's all also what you're seeing and the visual part of your screen. Now you can roll charts backwards and forwards, okay, but it's visually what you're seeing. So let me take you over a chart. And let's go look at this in a live chart, and I'll show you what I'm trying to explain to you. Hold on, I got charts set up here for you. Let's see if I have an empty one. Nope, I don't. Okay, so here is the Euro US dollar. It's a current chart. And we'll talk about what all these lines are that I put on here a little bit later. But we're looking at a 1 hour chart. So our time screen, our screen only can goes from here to here. So there's only so many lines we can put on here. So each one of these reflects a 1 hour time frame. So we can see down here at the bottom, this goes from the 27th of June all the way up here till today. If we were to change this chart to a 30-minute chart, okay, we see more detail in the current movement, but we see less on the frame. So right now, this chart only goes back until the 3rd of July. So this is your view screen. It's still the same prices. Price can never change on a chart. Okay. Remember, price on a chart is what was. It's actually happened. So you can break it down, you can add it, but that price was actually always at that price. At 10:30 this morning, wherever that Euro US dollar was, is where it is no matter what chart you're using. It's just what you're visually seeing in that time frame. So understanding time frames is important, because by using multiple time frames, you could actually sometimes figure out variances of an asset. You can see the personality of an asset. The other thing is your time frames should suit your style of trading. So in other words, if you're a short-term trader, a day trader, you're trading it for short whiles, you want to open a trade and close, you should be looking at shorter-term charts, because your only concern, their only concern is the current price and the current price movement. If you're a swing trader and you're looking to hold an asset from a week to a month to 2 months, Well, you're less concerned with the little volatility in the last half hour. I'm more concerned with where the overall price is moving over that period of time. But you can't ignore the short term just because you're a long-term trader, because you still need to be aware of how volatile that asset is. You need to be able to understand where to put your stop loss when you're trading so that you can cover the swing of the marketplace. So you can't just say, it's not that volatile right now, or it's not, so you need to use the appropriate time frame, but not ignore a shorter term frame. You should be able to see and look where things are moving. So it's important to use multiple time frames. Today, it's fairly easy because you can just click on a button. Okay. So if we wanted to see how the euro US dollar is trading over a longer period of time, we can go back and click on a one-day chart because it also gives you a perspective. Because if you look at this chart now, we're looking at a one-day chart. So this is taking us all the way back here until February. And we can see on this chart that the euro US dollar is actually in a nice strong uptrend since February. Would you agree? We see price moving steadily from here, steadily gaining upwards. We can see prior to February, we had a top, and then we see price coming in a downtrend. So this gives you a visual aspect and gives you some perspective of where we are at the current time. Because when we change this back to a shorter term chart, okay, we're going to say that the euro was in a strong uptrend, then it moved to a downtrend, then we're going to say it's moved upwards, and now we can say it's moved into a sideways consolidation, okay, which you would have not gotten that from the long term. But where is this sideways consolidation? That sideways consolidation is in a long term, since February, uptrend. So a consolidation in the middle of an uptrend is probably telling us a breakout. This is where the traders are hemming and high, and we're probably going to see it bounce back farther to reach a new high. Okay? Or it might be a retracement or a reversal. If we look at this in a shorter term again, okay, we would say, oh, look at that. The euro is trading today in a short-term uptrend. Well, so it gives you a different perspective, because if you were looking to day trade, this is what would be more important to you as opposed to how it's been trading in 1 hour over the last few days, except it gives you more intelligence. It gives you more basics for you to make a understanding of what you're looking at, to have some type of better understanding of what that asset is doing. It's like, say your kid's growing and growing like a weed, popped up 4 inches this year. He's a teenager. Well, that's fine. You're going to say, well, my kid went from 4'3" to 4'6" this year. And I'm sorry, I talk in feet and inches, not in meters. Okay. Now, the fact is he grew a lot this year, but is he still much too short for his overall classmates? It gives you that perspective. Are all of his classmates 4'6", 4'7", 4'8", and he just jumped from 4'3" to 4'6"? Now, did he jump from 4'3" up to 4 and stay still? Or maybe he's going to jump to 4'9" over the next 3 months. Okay. But it gives you some perspective in his movement as well as the perspective of how the other class is moving. So you're getting some type of better understanding. So that is what we call time frames. Okay. And you use these time frames, and they're, like I said, they're easily adjustable on any chart system you're using today. But time frames sometimes freak people out. Now, no matter what time frame, every chart will allow you to move it forward, but you can't move past where it's currently trading, and to move it backwards to see historic values and how time has been traded. And sometimes this is very important, to move it backwards and see where that asset has been, okay, and how volatile it is, or to look for points in common, prices in common. Because remember, everything with charts is visual. So let's go back to my PowerPoint. So we talked about the different types of charts, and we talked about time frames. And let me just pop this PowerPoint back up here for us. Okay. Now, Forex trading, CFD trading, commodities trading, futures trading, they all attract different types of traders with many different types of systems. If you want to trade a currency pair, it's best to become as familiar with it as possible. Viewing the currency pair in multiple time frames is part of the process of learning its personality. Understanding the currency's personality can help you in your success with charting. Now, one of the most important reasons we want to learn how to read a chart is so that we can use what's called technical analysis. Now, technical analysis can be very complicated or it can be very simple. The fact is, anything you do with a chart, whether it's just looking at the chart and looking at a bar chart, falls in the field of technical analysis. And there are two fields of trading or two fields of analysis. One's called fundamental analysis, the other is technical analysis. Fundamental analysis uses things like economic events, news headlines, world happenings, profit and loss statements from stocks, public earnings, public addresses, press releases to determine where an asset should or could be trading. But you're not going to be able to find target points, stop losses, entry and exit points without a chart. Because then if you say, oh, Mario Draghi came out and said he's going to start tightening his quantitative easing and he's going to start raising interest rates because inflation rates are climbing, that means the euro should go up. Okay, that makes sense. But do you have any idea from that, and you've made that analysis that euro should go up, what point you should enter a trade, where you'd have to put your stop loss to cover the volatility of the markets, and where you might want to put your target points, or as prices moving up, what areas do you think that might cause some congestion or reaction? You're only going to get that from charts because there's no other way to ascertain that information. Now, not every trader believes in using technical analysis, but it can be useful. And even if it's not your primary trading tool, method of trading, technical analysis relies on the price that is on the chart you are using. Now, even if you're a fundamental analyst or whatever other system or way you've decided to analyze the markets, you need to be able to look at charts. Okay. Now, even if you look at a bare line chart, technically, I can look in the morning at an economics calendar, and I can then come home in the evening and look at it, just even a bare line chart, and tell you that event was positive, that event was negative, something else happened to affect the euro, and tell you a story that happened that day. If I look at a bar chart, I can almost tell you how good or how bad that economic report was. Okay, and you can actually tell the story of that asset and what happened during the day without looking at the news, the headlines, or anything else, but just looking. You knew what was scheduled on the public market. We knew when we had problems with North Korea, we knew we had some economic demand, but then I could look at that chart and tell you a story of exactly, because I don't really care that the non-farms payroll report was 197,000. I just know it was a good report. That's all that really mattered because it pushed the dollar up. No. And there are three basic things you need to be able to put on this chart to build your basic roadmap. Because even if you're looking at a roadmap, like again, we'll go back when I started driving, I was the kind of guy that I'd call and ask directions to where I was going. I kind of jot them down, and I'd hardly look at a map, and I ended up pulling off the highway so many times, trying to figure out where I was going, pulling the filling stations, asking for directions, because I wasn't that good with maps. Now, my business partner was great with maps. So if Peter was in the car while we were going to a meeting, I knew we didn't have to ask anything. As long as we had the address, he would get us there, and he would get us right into the parking garage at the right place without ever making a wrong turn, because he could read every detail on the map. He could, if there was a backup on the highway and we need to get off the highway to get around, he would know exactly where to exit, where to go around, and how to get around that accident on the highway. He would be able to say, oh, you know what, traffic's slowing down. Maybe we should take a side route. And we would never get lost because he could read every detail. Me, I was a little bit too lazy. Well, so I was always getting lost. Now, there are three integral parts of using a chart before we get into the involved stuff of putting all kinds of indicators and oscillators on a chart. And these start building that roadmap for you. Okay. And these are basic simple lines. One's called a trend line. The other line is called support and resistance. And then the third is volume. And really with these three things, you can make very good trading decisions. And these aren't complex, these are simple basic lines. But if I were to tell you volume shows up on a chart, that means that's kind of tell you how many traders are executing trades. If you see price moving up and volume increasing, what do you think that's telling you? That the traders believe in that price movement and they're supporting that price up. If you saw price moving up, but you saw volume falling, that's telling you the traders are starting to leave that or not supporting that trend. That price is probably going to start reversing itself. If you saw price moving up and the volume stayed fairly even, you're saying traders have some belief in that. Not complicated, is it? When you stop and think about it, and the only place you see volume is on a chart. Now, if I add with that a trend line, and trend lines are basically lines that are supporting a price movement either up or down or sideways. And if you look at this, here we have a roadmap of London, right? And surrounding area. Here I have a chart for natural gas. They don't look all that different, do they? And both of them look kind of complicated to your eye. But once you understand how to read them, you'd be surprised. This isn't my chart. This is somebody else's chart. And reading somebody else's chart is usually very difficult. But once you've learned how to read charts, you can take a second and you can understand and interpret everything that's on that chart. And everything is trying to tell you what all these indicators are doing, what they all represent, and you can get a very good understanding of the markets. Now, trend lines are very important lines. They are the backbone of trading alpha charts. And you will read almost everything you read. We'll talk about the trend moving up, the trend moving down, the trend sideways or congestion. Okay. Anytime you look at a chart, every charting system, every trading system, every strategy will always have a trend line on a chart. And a trend line is just a straight line, but it has rules to it. So as well as showing the direction and strength of the current price movement, trend lines also show potential support and resistance for that trend. When price is moving up and you can draw a trend line correctly, price will be expected to stay above that trend line. So if it eases down, it will probably touch that trend line and bounce back off of it. When it breaks that trend line, it tells you traders no longer believe in that trend. Now, and there are many trend line trading systems that are completely based on the support and resistance of trend lines. So tonight, we're not going to talk about the rules for drawing a trend line. And there are very strict rules. But we'll talk about the importance of trend lines and on chart. Because a trend line, now when price is moving up, a trend line is drawn underneath the current price movement. When trends are moving down, they're drawn above. So a trend line under an up moving price is supporting the price above it. Once price breaks through this trend line, that trend line is over. It's invalid. Now, when you put a trend line, and you learn the rules for putting a trend line on a chart, and the rules are very important because your trend line should be exactly like all the other millions of traders around the world. You're not trying to come up with a customized thing. You're not trying to sneak something in or outsmart the markets. A trend line should be the same as the guy across the world from you. Drawn exactly the same way, and that's why there's rules. Because what a trend line will help you do is find a price point on a chart that you expect some type of market reaction. There's no law that says it can't break the trend line. There's no law that says price can't just fall right through it. But historically and statistically, price will come near that trend line and then bounce off of it. When it touches that trend line and goes through, you're going to expect, as it gets closer to that trend line, you're going to watch for the market to have some type of reaction, whether it's going to bounce off that trend line or break through. But that's going to tell you something about how that asset's going to move that way forward. So if you saw, in this case, price come down to that trend line and not break through it, you're expecting it to move back up. Again, it comes back to that trend line and bounces off of it and continues back up. Goes back down to this trend line and bounces off of it. Now, this is the way a trend line should move, because price doesn't move in a straight direction. And the only place you'll see it, because price should move in what we call thrusts and ease, or peaks and valleys. Price should push up and then ease down a wee bit, then push back up and ease down a bit, push back up and then ease down and then push back up. Now, there's rules about these pushes, but they can't break that trend line. Okay? And this is the way a good constructed trend and a good constructed market will move, because the buyers buy and then they stop. You know, if you had so much money to invest and you invest in the money in the market, you're one buyer that's not, you know, you own, but you're not trading anymore. So the market eases down. Then the buyers get their momentum back and they push it back up. And this is what's supposed to happen. Peaks and valleys are thrusts and eases. And when you see this on a chart, you know you have a very well-formed trend that is supporting that current price movement upward. So if you say hypothetically entered the market here, okay, you don't want to panic when it comes back down to the trend line. You want to stay in that market. You want to ride it all the way up to here. So you need things to support that price move to let you know it's staying on that trend. So if you saw volume, which falls on the bottom of your chart, continuing a nice upward or nice even movement, you wouldn't worry about the price easing down, because you would then know that that's simply a retracement and price is going to push back up. Now, this is an important part of charts. So one of the most important lines you can use is a trend line. And we have all kinds of classes about trend lines. Later this month we have Mastering Trend Trading. We have The Trend is Your Friend. But this is something, because you have to learn all the rules. It's not a lot of them. But too many traders say, oh, I can draw a straight line and connect the dots and come up with a trend line anywhere I want. That's the problem. You need to draw it by the rules so that your trend line matches the guy across the world, so that you know what price is important to the markets. Because before you can outsmart them, you have to understand what they're looking at. Then next, we go on to what we call support and resistance. Okay. So once you've got your trend lines on and learned how to draw them, you go on to the next set of I'm just trying to get up to the right. Support and resistance. The concept of support and resistance is simple. Support can be thought as the floor for the price, while resistance can be thought of as the ceiling for the price. When the price breaks through this resistance, that level becomes the new important support level. So imagine price is moving in an elevator. So I paint you gold and I put across your chest $12.50. I shove you in an elevator. What is supporting you where you're standing? The floor. If you want to move up, you have to break the ceiling. That's your resistance. When you move up to the next level, that ceiling you just broke through becomes your floor under your feet, or your support level, and that ceiling becomes your next resistance level. Okay. Now, when you know what these levels are as price moves up, and these prices come from support and resistance can be ascertained in many different ways. You have support and resistance lines from your trend line, because the price above the trend line is supporting that price movement up. And as long as it stays above that, it's got the support. So that trend line is supporting that action as it moves up. Then you have what I call eyeballing. And eyeballing support and resistance is looking at a chart and drawing lines on common prices where the buyers have hemmed and hawed in the past, and see what price levels have been important to the buyers, okay, or the sellers, but the traders in the past. So if we know that the euro at 110.50 is a crucial level, and even over the last year, every time it got up to fell down to 111.50, and I'm making this number up, the buyers started buying again and pushed it back up off of there, and then 2 weeks later it fell back down to 11.50 and then bounced off of there, and then a month later it fell. And every time we saw this 11.50 number, that's an important number. And you can draw that on a line across your charts because price, again, doesn't move in a straight through method. So we have whole classes on support and resistance. And it's very important to learn that because once you put support and resistance, a trend line and volume on a chart, you actually have an entire trading system that you can actually make smart, intelligent trades from by using just those three. There's all types of famous trading systems, or there's like these automated packages like auto charts. It's all based on those exact pieces of information. You don't have to get involved in RSI and stochastics and MACD. And yes, you can, and you can learn these more intricate and involved indicators and oscillators and build them into your trading system. But you can actually start with some very basic, simple trading systems that work effectively. It's just a matter of learning how to read a chart and put the bare basic lines on a chart. Now, after you do this, you can then build something more valuable. So hold on, let me bring the charts back up here. So when we were talking before, I said these lines were lines I drew on the chart before. Okay. Now, these lines that I've drawn on a chart, okay, let's do the dashed line. These were support and resistance lines that were drawn by eyeballing when price was moving back here. And this helped us isolate prices. Okay. So when price peaked up back here in trading and moved all the way up to that purple line, that was a line that was drawn from price, that important that price level was months before and drawn forward. And look at what happened when price reached that level in this large upward movement. It broke through it. But we had a top right there, we had a little resistance there, and then it broke through, so we knew it was going to continue climbing. But the next level we had was up here at this purple. And look, as it moved all the way up to that higher purple dashed line, it bounced off it and then reversed. Then we have on our chart over here what's called Fibonacci retracements, and these are levels of support and resistance based on ratios. And when this was put on a chart, and this is put on a chart at the end of a trend, so when this uptrend ended, we were able to drop this on, and then look at how important these crucial support and resistance lines have been to this price. But these prices were drawn on that chart. Sorry, I'm just trying to get my marker up here. Those prices were drawn on that chart here. And look at that, moving forward, we can isolate all important price levels using support and resistance from Fibonacci levels. So there are many ways we can do this that aren't that complicated, but you have to learn each one of these trading tools individually. Or, here you can see a very complicated chart for two digital currencies and all the projections and moving forward and how you would use a chart. And so here we have an uptrend. We have a support downtrend. We also have it forming what's called a wedge. When it's forming in this wedge and it comes together, you're going to expect, because what happens is the buyers and sellers are starting to get pent up in this wedge. And then when they break out, we can predict how far that movement should be from the breakout. But when it forms a breakout, we can expect it then to reverse to support the trend or break the trend. And then here we can then add we've drawn a new trend line on, and we've been able to predict this entire downward movement very successfully using our wedges, our triangles, using our support and resistance. Okay, and using that to make trading decisions. Now, none of this is that complicated. These are very basic, simple little trading scenarios, but when you put them together and learn how to use them, you can then start making educated, important trading decisions. But they all involve charting basics. Okay? And you've got to learn to use your charts. Just to look at them, even if you don't want to get involved in the complicated, just learn to look at them. Because a lot of people say, well, that's too complicated. How do I do all this and all these charts? Well, the problem with most people is they're trading way too many assets. Okay? So therefore, it's very hard to have many charts and many setups. Okay? If you're a smart, successful trader, you will find a group of assets, and in your trading plan, not your trading strategy, your trading plan, that includes how much you're going to risk, what your risk management is, how much you'll invest per trade, even what time of day you trade, maybe how many trades per week you'll allow yourself. Okay. All of this is part of your trading plan. Okay. When you build your trading plan, you should also build in what assets you are looking at trading, because you can't be an expert. I mean, I traded an open account in the commodities market for years back in 1982, 83, and 84, and all I traded was agriculturals. Today, because the platforms are so extensive and offer so many assets, I see traders, well, this is my system, and I just drop it on charts, and when something happens, I just do it. They end up losing their money. You're better off becoming a specialist in a couple currencies or a couple assets or a couple commodities and knowing them in and out and spending your time evaluating them and having your charts all built and understanding the historical part and all of that about those assets. And spend your time with your charts and looking for possible glitches in the market, looking for openings to get good trades as opposed to jumping all over the place. But a chart is the best way. So my suggestion to everybody out there is take an asset. It doesn't matter for what reason. I mean, if you're going to Australia on vacation this year, so take the Australian GBP. Maybe it's your golden wedding anniversary, so you want to take gold. I mean, if you're a Bitcoin fanatic, take Bitcoin. Or you want to follow the new Ethereum, take Ethereum. Take whatever interests you, not for trading purposes. Just start looking at a chart every day. Start learning that asset. Because once you see and start seeing things in a chart, you can then apply it to all the other assets and seeing charts. But it's getting you familiar. It's like getting you ready to read a road atlas. Once you're familiar with reading a road atlas and know what all those symbols mean and all those movements mean, it doesn't matter whether you're looking for Wales, doesn't matter if you're looking in Northern Ireland, doesn't matter whether you're looking in Scotland, doesn't matter if you're looking in France, doesn't matter if you're still going to be able to read that map just fine. So on that note, I will say good night to everybody. Thank you very much for joining us. And this class has been recorded. It will be available to you in 24 hours from now by using the same link you used to come to this class. So instead of coming to the live class, you will come to the recorded class. So thank you very much. Thanks for being part of our family. Thanks for supporting X90. And most of all, thanks for being part of the investing.com family. Have a good night now.